Welcome back, everybody, to Volatility Trading Strategies. So we're moving on to part 2 now of this video series talking about possible replacement ETFs for my VB Threshold Strategy. For context, this is the full strategy as I've designed it. Now the issue is the VTS community does have some active traders in it, and some of them like to experiment, maybe change a few things, try to adapt it to their own level of risk tolerance. So this video series is about me trying to help them do that with some actual data for comparisons. Now, for all of this to make sense to you, there's a couple of videos that you should probably watch before this one, or maybe afterwards if this video intrigues you, and I'll leave a link to both of those here. The first video is explaining what my volatility barometer is. Now, the super short version here is that I've created my own index based on a multitude of volatility metrics that give me the most accurate and practical measurement of market volatility. And the second video you should watch is the full breakdown of my VB threshold strategy, which uses those volatility barometer values to divide the market into 20% sections. Once the market is effectively divided into 20% sections, representing different levels of overall market volatility, from there each section will be holding a different ETF that I feel performs best in each range. So I've already done part 1 of this replacement series talking about the 20 to 40% section. When the volatility barometer is in that section, I like to hold the Volatility ETP ZIV. So you can check out part 1 of this series where I come to the conclusion that the best possible replacement for ZIV could be short VXX instead. It is a more aggressive position, but it will probably be more profitable if the investor can stomach the larger expected drawdowns. Today, I'm going to go over some possible replacements for that 40 to 60% range of the VB threshold strategy. So subscribe to the channel, smash the like button for me if you don't mind, and let's get into some comparisons. So like I said, today I want to show all the potential replacements for the 40 to 60% range of the volatility barometer values. For this section, I feel the most consistent performance comes from holding the SPY. That's the one I use. It's an ETF that tracks the S&P 500, broad stock market. And here's what the performance looks like for just that section of the strategy. You can see that since inception of my volatility barometer in January of 2011, it spent 24.48% of the time in this 40 to 60% section. About 25% of the time it's in this range. And the S&P 500 has been pretty consistent in that range as well. Total return of 18.67%, with a maximum drawdown of only minus 13.01%. So pretty decent, that's why I use it. It's all about consistency. Remember, the entire strategy combined already has a very high rate of return, so I don't feel the need to get too aggressive. For me, it's about consistency. But your first curiosity might be just leveraging the S&P 500, and possibly using the SSO, which is a 2 times leveraged S&P 500 ETF. Now, performance-wise, of course it's going to be higher. It's leveraged, so this isn't surprising. It's a 27.69% total return in this section compared to the 18.67% of the SPY. The problem is, because of that leverage, the maximum drawdown is now about as large as the return at minus 25.06%. To me, this violates the philosophy of the strategy, and my own level of risk tolerance for that matter. So using SSO, in my opinion, is not a viable option. Now this one may surprise you. This is what it looks like when using ZIV in the 40 to 60% section instead of the S&P 500. It's obviously pretty hit and miss here. Essentially flat performance, but still a pretty big drawdown. Considering how well the ZIV performs in the lower 20 to 40% section, you may have been expecting this to still be pretty good, but it's clearly not. This is something that I've written about quite a bit in my daily blogs that I send out to the VTS community every morning. Being a contrarian when trading volatility is just not a very good idea. When volatility is elevated, like it is in that 40 to 60% section, that typically represents turning points. A majority of the time, of course, volatility does end up declining from there. And if you are short volatility, you can make a pretty decent profit during that period. If you catch it right, you feel pretty good about yourself that you timed volatility correctly and you made a nice profit. But every now and then, when volatility is in that middle range, that ambiguous range, it's on its way to something higher. And that's when holding short volatility can really be costly. And that's what we're seeing here. There's short periods of pretty good success along the way. But when volatility goes higher instead of lower in this turning point range, which it sometimes does, you can potentially give back all the profit that was made before and then some. And here we're seeing the same thing, but even worse. Instead of ZIV now, this is the full short VXX position. Even more aggressive than ZIV, and this is quite a disaster. Again, these periods here represent some big profit being made quite quickly. But it can't make up for the other times when the opposite is true. In the 40 to 60% range of the volatility barometer, in my opinion, it is best to stay away from short volatility positions. The last one I'll go over here is, I guess, a possible replacement under the right circumstances. This is the TLT, 20-plus year U.S. Treasuries. Overall, the results have been positive in the last 8 years. But you can see what's happening in this chart. This first section corresponds to low interest rates before the Fed came in and started taking action. Remember, there's an inverse relationship between interest rates and bond returns. If interest rates go down, bond funds like the TLT perform well. In a rising interest rate environment, they don't. So in the last 4 years, the Fed raised interest rates 9 times. And you can see the performance of TLT suffered during that period. But just in the last few months, the Fed has done a complete 180 and are now taking aggressive steps to again start reducing interest rates. They already cut rates once last meeting, and the odds are they may even cut 50 basis points in the next meeting. As a result, look at the performance. It's going up strongly again recently. So as far as a replacement for the S&P 500, TLT bonds can work well, if we're in a stable rate environment, or ideally we're in a declining interest rate environment. That's going to be a really nice tailwind for the TLT. So if a person wanted to, they could try to match their position in this 40 to 60% range with their predictions on what future Fed policy will be. This is the head-to-head comparison, S&P 500 with the SPY versus 20-year Treasuries and the TLT. Now if this continues for a few more months, which based on Fed language in the last few meetings it definitely could, we could find these two being about equal in absolute performance very shortly. One could make a case that Treasuries are a viable replacement. But in my mind, there's no doubt the SPY has been far more consistent, performing pretty well in both of those interest rate environments. To me, successful long-term investing already has several unknown variables that we have to navigate. I personally don't want to add Fed policy to the mix. That's why in this 40 to 60% range of volatility barometer values, I stick to the S&P 500. The performance has been good, the drawdowns are very manageable, and I think personally this is the best solution for the VB Threshold Strategy. Having said that, if you want to try to time Fed policy, we could consider the TLT as a possible viable replacement here. So if you are interested in this strategy, I give out the daily trade signals every single morning to the VTS community. You can head on over to my website, claim your free trial, and see if the VTS community is suitable for your long-term investing goals. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.